chat the different objectives that I feel like we did not have a chance to really go through in class. So I'm going to talk about changes in tax rates, about NOLs. 18.7 will not be tested, and talk about disclosures. So let me flip down to 18.5. All right, change in tax rates. And this happens all the time. And this was a really big deal when Trump came into office because he significantly lowered the tax rate for corporations. He wanted them just to have a flat, simple rate, it to be lower, and companies were pretty excited about it. I think that the tax rate used to be in the 30s to 40s. With his administration's changes, the corporate tax rate was 22%. So you've got a lot of deferred tax assets and liabilities that relate to future events and future tax filings. So you need to make an adjustment when tax rates change. And I think you're going to find this much simpler than it sounds. So, for example, we've been talking about the fact that when you try to determine your DTAs and DTLs, I've been asking you to draw out the two T accounts, one with your GAAP books and one with your tax books of the item, whether it's an accrual, equipment, etc., and calculate the difference. And you do that every year. So when you've got a change in tax rate, it is as simple as taking that difference and just multiplying it by the new rate. Right? And then it helps you build your entry from there. So in this example, this company has one temporary difference of $50,000 due to an accrual. So it has a GAAP basis of $50,000, a tax basis of 0. The new tax rate is 25%. We don't care that it used to be 40, right? That probably did drive how some of the accounting worked in the past, but for our purposes, we just need to know the new rate and that our DTA ending balance should be $12,500. Now remember, we're always trying to get to that ending balance when we take the differences between the GAAP and the tax and multiply it times the rate. This is how we make the adjustment for the change in tax rate, because you can see at the old tax rate it was $20,000. That was our beginning balance. So we know we've got to make this $7,500 adjustment. So we'll credit the DTA by $7,500. That brings it in line with the new tax rate. This made almost every corporation's tax expense look so wonky. I'm trying to think of the year. I think it would have been 2018 when the tax rate went into effect. Okay, let's do one more. Boulder has one taxable temporary difference of $40,000 related to a fixed asset with a GAAP basis of $40,000 and a tax basis of 0. So for tax, we've gone ahead and depreciated this whole thing. We need our DTL balance to be 25% of that difference in basis, the difference between the GAAP of $40,000, the tax of 0. Multiply it times the new tax rate, and we want the DTL to have an ending balance of 10. In my T account, I plug in the ending balance of 10 as well as the beginning balance of 16, and I know I've got this $6,000 adjustment to make. All right, what happens if there's multiple tax rates? And this is a very realistic scenario. It's not one that we're currently in, but it could easily happen again in the next 30 years. In that case, the tax department has a much harder job because they can't just look at the total bases difference and apply one percentage. Instead, they have to take that bases difference and plug it into the years where those differences will reverse. Right? So here, they're just going to give us the information, which makes our lives easier. Right? So they're telling us that of that $5,000 bases difference, it will reverse 2,000 in 2021, 2022 will have 2,000, and 2023 will have 2,000. What do we mean by reverse? We mean, for example, as our tax bases and our GAAP bases in equipment gets closer together, you end up using some of those DTLs that you had recorded. So they've given us the fact that we've got these different reversals coming up. They give us the different rates. We apply them to come up with what our total DTL balance should be. And again, we record it as normal. If you want to practice this on the class pack, I'm not including it in the video because I feel like it's pretty straightforward, but the answer to the class pack is on TCU Online. All right, next one. Net operating loss carry forwards. A lot of times companies lose money. And when they do, if they've lost money for both their GAAP financials and their tax financials, they really don't have a tax bill to the government. So you think to yourself, well, gosh, that's nice. Do you get any benefit from it? Yes, they do. If they lose money today, if they have a taxable loss, they're not going to pay the government anything. However, they can carry that loss forward, meaning if they lost some money this year, they can apply that loss to future income, almost like a deduction, right? And so right now, the rules say you can carry forward those losses indefinitely, right? But every year you can only offset 80% of your income. So, for example, if I had $100 in income in year 2, I can only offset $80 of that income with any loss I'm carrying forward. So let's take a look here. We've got Whitewater that had an operating loss for tax purposes of $65,000 in 2020. So they're not giving us their GAAP books. They're just telling us, hey, their tax return, they had a loss of $65,000. Management has to decide, okay, do we think we'll become profitable enough to use it? And what they're saying is, yes, we think we're going to have future taxable income of $10,000, $5,000, $50,000, and $60,000. Now notice, this is important. That totals up more than $65,000. That's not my benefit. My benefit can only reach $65,000, and even then I have to haircut it, right, to that 80%. So I say, for example, in 2021, I think I'm going to earn $10,000. I know I can offset $8,000 of it with that loss carry forward, and my tax rate is 35%. Now here we've got multiple tax rates based on the year, so we have to take that into account. Again, we think our future earnings will be $5,000. Multiply that by 80%. Great, we can deduct $4,000 from our tax bill in 2022, etc. So our estimated tax savings is $17,050. How's that manifest itself into a journal entry? What I'm going to do is take that total estimated savings and I'm actually going to credit tax expense. That's going to feel super strange. Remember, this is only when you're initially recording your loss. And so think about how the income statement looks. Go down here, look at the bottom of the page. We've got a loss, right? Operating loss before income tax. And then we show that benefit for a net benefit. It's the little piece of good news that we have when we've got a loss on our GAAP income statement. Now, let's assume that they become profitable in 2021 and they have actual income of $15,000. Back in our previous slide, they guessed they'd have 10, right? Nobody tends to guess exactly right. They have 15,000. We're also going to assume that evidence indicates that it's more likely than not only 70% of that deferred tax asset will be realized. I don't know why that would be, but we'll just go with it. So we start off with the 65,000, right? This is our NOL. Then we say, okay, we've made $15,000 this year. If I haircut that by 80%, that means I'm going to use $12,000 of that net operating loss. That leaves me $53,000 more to use in the future. That sounds like good news, except they've just said that we don't think we'll get it all. So we'll come back to that in a second. But I multiply it times the tax rate. So the amount I think I have in the future times the tax rate. And I want the DTA balance to be $13,250. It was a balance of $17,050 from my previous. So I've got an adjustment of $3,800. Credit the DTA. On my income tax payable, I've got, let's see, how did they do this here? On the income tax payable, they took the $15,000 that we earned this year times the current year rate. Sorry, you guys, I'm stumped for a second. Oh, yes, because we were able to deduct, we only have to pay 20% of this $15,000, right? Times 35%, which is our new rate. Is that what they've told us? Let me just go back and be sure. in 2022, yes, we got that new rate. All right, that gives us the total of the 1,050. When I add the two together, I get back to my income tax expense. Now, where does this 70% come into play? Remember the VAs we talked about already, where we've got to go ahead and do a valuation allowance when we don't think we can use all of our deferred tax assets? We're taking the balance in the VA and saying, you know what, I don't think I'm going to get 30% of that. So I multiply that by 30% and I record additional income tax expense. So this problem had a little bit of everything, changing rates, NOL carry forwards, as well as a VA. So it probably feels a little overwhelming because you're practicing 3 different things. But as you work through the homework, you'll get more comfortable with it. Okay, last one. Remember, I'm not going to test you on 18-7. What do these things look like in the financial statements? So, important piece. In general, you're going to see it 2 different ways. On some companies' income statement, you're going to see the DTA in assets, the DTL in liabilities, and then the VA as a contra asset. That's usually where in a very complex corporate structure where they have multiple entities that owe taxes. Companies that have a simpler structure where it is only one legal entity that's paying the taxes versus several, they'll net these 3 together. And so you'll just see a net either DTA or DTL. However, if you go to the footnotes, you can get all of the information you want. So, for example, this company's has netted it, but you can see if you look at it, well, their DTAs were 24.56. They've only got 1 DTL, property and equipment, and so their net is the 50.6. So we would see the 50.6 as a net liability. There's also some interesting things where they show rate reconciliations, etc. And let's practice this one really quick. So we've got a DTA of $100,000. Right, there's a VA of $50,000. And we got a DTL of $120,000. So how are we going to report this? Okay, well, we've got a net asset of 50, a net liability of 120. So what we need to do here is 120, right, minus 50 equals, we're going to have a net DTL of 70,000. All right, that's it for this chapter.